Do you want to learn how to get retired, stay retired, and enjoy your life to the fullest? This is the Retire Happy Podcast with certified financial planner professional Jeremy Finger. Jeremy will be your guide to happiness as he discusses the art and science of retirement, breaking down the complicated information to help you make good financial decisions without worry or burden. Now, on to the show.
Hello and welcome to Retire Happy with Jeremy Finger. Jeremy, what's going on today?
Oh man, just living a good life, brother. How about yourself?
Doing well. You know, I always want to say it's that time of year, but it really is always that time of year, right? Something's going on.
Yeah.
But no, it's good. Living life is going well, and I'm enjoying being back with you. I know that we've got some interesting stuff to talk about today, and I know a little bit about it, but not much. And you're talking about tax planning and retirement, and specifically Roth conversions.
Yeah, that's a lot of people have questions about that. You know, guess what? They realize when they get retired, they realize that they have to pay some taxes. So there's a lot of things that people can do in retirement to help maybe not give the IRS more than their fair share, so to speak.
Got it. Yeah. We don't want the uncle taking more than he's supposed to. That's for sure. So how does Roth conversion, how does it fit into the overall plan?
Yeah. So here's how it really fits into it. Well, so let's start with what's a Roth IRA. Okay. You know, so we can give base level here. It is a Roth IRA is a retirement account that can grow tax-free and withdrawals could come out tax-free. And again, tax-free growth, tax-free withdrawals. But there are some caveats with that, okay? So you got to have a Roth IRA for more than 5 years. Now people say, hey, do I have to have the same account number? All that? No. If you have any Roth IRA in your name, that starts the clock, okay? Mm-hmm. So you know, that I've seen some retirees, you know, want to do Roth conversions and they've never had a Roth IRA. So you're like, wait a second now. All right, that's fine, but you got to make sure that when you do a conversion and put money into a Roth IRA, that you don't need that money at least for 5 years.
Oh, okay.
Yeah, otherwise, you're going to may have to pay some taxes on that money coming out if you try to take it out too soon. Yeah, and a couple things about Roth IRAs and why, you know, that are beneficial is that they avoid required minimum distributions. Mm-hmm. And required minimum distributions, for those who are the younger folk in the audience, is when you turn 72 years old, if you have a pre-tax retirement account, like a 401k or an IRA, because all of you done a great job of saving, right? Is the government is going to force you to take some money out at 72. Now, why do they want to do that? Because they want to tax
their money. They want their money.
Give me my money.
That's
Give
right.
me my money. That's right. But Roth IRAs avoid the RMDs. So, and why? Because you've already paid the taxes on them. Okay. So,
got it.
Yeah. So that's what the Roth IRA is. A lot of times people get confused on what the contribution, if they can contribute to an IRA, a Roth IRA, or what the conversions are. So the difference between contributions and conversions. So if you're trying to put money into a Roth IRA as a contribution, meaning that you have earned income, and hey, I want to contribute to a Roth IRA, there are some income limitations. Okay. Mm-hmm. If you make too much money, Eric, you know, like a lot of successful people like yourself do, you may not qualify for a Roth contribution.
Let me tell you, I qualify all day long. I do not make enough money to not qualify for a Roth.
Come on, man. You're just like Joe Rogan making all this money and everything, right?
Uh-huh.
So, but you know, you, okay, me, and guess what? Even Joe Rogan probably can do Roth conversions. If you have a pre-tax IRA, there's no income limitation on the conversion. So, but there are some things that you need to think about, Eric. So a lot of times people say, well, when's the best time to do a conversion? Here's the easy way to think about it. When do you want to buy anything is when it's on sale, right?
Mm-hmm.
All right. You want to pay your taxes when it's on sale. So
what's that mean?
What's that mean? All right. So if you're a high income earner and you're working all your life, when you retire, guess what? You're no longer earning money, so to speak. So guess what? You may, tax-wise, be in a low tax bracket. Therefore, your taxes may be on sale in retirement.
Got it.
Does that make sense?
Yeah. So breaking it down, since converting from a traditional IRA to a Roth IRA creates a taxable event, right? Depending on the amount of money, if you do it too soon, so let's say you did it the last year you were working, your last full salary, you did it that same year, that could actually push you into a much higher tax bracket, is what you're telling me.
100% the case. And when do you want to pay taxes?
When they're on sale.
When they're on sale. That's exactly right. That's right.
So that next year, after you're retired and you don't have your regular salary, your regular income coming in, then you can figure out a number, the magic number, which is what you do.
Right.
Figure out how much you want to convert in that year so you don't get in the upper tax bracket, you stay in a lower tax bracket, therefore it being on sale.
Exactly
Okay, I'm getting this, man. Right. If I can get this, anybody in the audience can get this.
Come on now. That's right. I hear you. So a lot of times, if there's a pretty cool visual, it's almost like the retirement tax valley. So like if you're a high income earner, think about it, you're on the edge of the valley. And then when you retire, you drop down into the retirement tax valley, which is the lower tax bracket years. Mm-hmm. And then you go back up the other side. Now, what does that mean by going back up the other side and taxes no longer being on sale? Is usually when you turn 72 and there's required minimum distributions. Mm-hmm.
Those aren't,
because those required minimum distributions are taxable.
Yeah.
Okay.
Got it.
That's right. That's right. So really taking advantage of your retirement tax valley to pay taxes that are on sale. You know, another little caveat with this is that, and we're currently experiencing this now in the middle of 2022, is that when markets are down, that's a quasi way of it also being on sale.
Okay. How so?
All right. So let's say, for instance, that, I mean, all the listeners have well over $2 million in their IRAs, right? So if they've invested the money and the $2 million IRA is now worth, call it $1.5 million, they can take some of those shares of some of those investments in that IRA and transfer those into a Roth IRA. So the value of those shares are lower, and you only pay taxes on the dollar amount that you move from the traditional IRA to the Roth IRA. And so, and then if the markets come back or when they come back, the investments will then be growing in the tax-free environment of the Roth IRA.
Okay.
Does that make sense, Eric?
It does. It does. I don't know how that plays into tax loss harvesting. Is that something that you look at as well, or in conjunction with, or as opposed to? I mean, how does that work? Because I've heard you say something about tax loss harvesting before, but how would it play in this scenario?
Okay, perfect. All right. So let me converting in a down market. So you're paying taxes at the lower price level because you're paying only on the dollar amount you convert. Mm-hmm. And then when things come back, it grows in a tax-free environment. That
makes sense, yes.
All right, so that's converting in a down market. What you're talking about, tax loss harvesting, is a fantastic tax planning opportunity that people need to be mindful of all the time, okay? Let me give you an example. So let's say, for instance, that you bought XYZ, mutual fund, stock, it doesn't matter, in a taxable account. And you put $100,000 in it, now it's worth $90,000. If it's down, you have the ability to sell that XYZ at $90,000 and reinvest that in something else that's very similar but not the same, and you're able to take those losses against any future gains. Okay? Mm-hmm. So you can basically take this $10,000 loss and stick it in your pocket and wait until you have any future gains, and you can apply that $10,000 loss against any future gains. And if you have a $10,000 gain in the future, you can have that offset. So in other words, you got a $10,000 loss, you got a $10,000 gain, that nets out to zero, and guess how much taxes you got to pay on capital gains in that instance?
Zippo,
exactly. And you need to really be thinking about that all throughout the year. Okay, that's one thing that we're mindful of, especially in volatile environments, so that you're being you're trying to build up as much tax loss carried forward as you can. Also being mindful of, hey, you don't want to go and buy garbage just because it's a loss,
Yeah.
So be mindful of that. And that's another way you can do some great tax planning.
Okay, so let me ask you this, because I'm really interested in how this could work with a Roth conversion. I know that there's a 30-day waiting period, if I'm not mistaken, and you can correct me on that.
That's right.
So when you do some tax loss harvesting, you sell the stock at a loss. You're buying, and let's say we're just going to stick in the tech industry. So let's say XYZ is a tech stock, you sell it for a loss, and ABC is another tech stock that you then buy with, from the sale of that, right? And then you have to wait 30 days before you could, if you wanted to buy the other one back, you have to wait 30 days.
That's right. It's called wash sale rule. Like if you bought it today and you try to book the loss, and then you bought ABC, and then, hey, 3 days later you wanted to buy it back, the government's going to say no on that.
So you got to wait 30.
You got to wait 30 days plus 1, so 31 days.
31 days, perfect. Thank you for
31 days, and so that you can book that loss. And that's part of a smart tax planning. And so a lot of times what people do, or what you can do, is that if you have a diversified portfolio, treating these volatile environments as an opportune time for tax loss harvesting, but you can do so by simultaneously rebalancing. Okay? Let me give you an example. So let's say, for instance, that you got, 60% stock portfolio and a 40% bond, and the markets went down, and now it's 50-50. Okay? You can maybe just sell some of those bonds that may have done well and shift those over into the stock areas that have done not as well. So you're simultaneously selling high, buying low. That's called strategic rebalancing. Okay? So you can book some losses in some instances, and then also book some gains in others. But so collectively, you're monitoring all that to hopefully have a taxable loss going forward.
Okay, so let me ask you this. Okay, and we're going to get a little more complicated, but I know you can handle this. I got questions.
I just had my coffee, so hopefully it hadn't kicked in quite yet, but we'll see.
All right, so let's say you tax loss harvest, right? You wait that 31 days.
Right.
And then you say, you know what, I want to get back into that company because I believe it's going to make a little bit of a rebound.
Right.
So you do that. At that point, would it be smart to do a Roth conversion? Right? Because you've harvested the loss, and most people probably can't convert everything all at once, because that would definitely kick them into a higher, like you said, if you're talking about $2 million in a traditional IRA, or now it's 1.5 because of the loss, probably not going to convert that entire thing, because that's going to be a huge taxable event. You're going to do a certain amount each year, correct?
Okay. The answer is yeah, but let me make a big distinction here, Eric.
Please, yeah.
Okay, all right. So when you're talking about tax loss harvesting, you're talking about really doing that in a taxable account. That would be like a joint account, a single account, or a trust account. All right, that's tax loss harvesting, okay, in a taxable account. Now, the Roth conversions, you do that from an IRA, right, from a traditional IRA in many instances to the Roth IRA. Now, if you have some losses carried forward when you're doing these tax loss harvesting in a taxable account, you can carry some of those over to ordinary income, but you can only do $3,000 a year. So it's not a huge, it's not like, hey, I've got $50,000 worth of losses carried forward. Can that offset my ordinary income? Unfortunately, no. You can only do $3,000 a year, buddy.
Okay, well, that clears that up. That's exactly why I come to you with these questions, because you know what you're doing.
Yeah. So let me give you an example. All right. And see, this is important. There's a lot of different things that go on with someone's life that can affect them, right? So like when you're really thinking about what dollar amount you want to convert, or if it makes sense for you, you really need to take a look at, hey, okay, just like you said, do you have any tax losses carried forward? Or, hey, guess what? Do you have any capital gains you've taken throughout the year? Okay. What's your pension income? What's your Social Security? And so you got to think in terms of, hey, what really has happened this year that's taxable? And because when you do a conversion, you cannot go backwards. There's no, you cannot, you're done. I mean, your butt's done. And so what we try to do is take, let's say October, November, December, look backwards throughout the year at all the different taxable events. You stack them on top of each other. And if you do a conversion, is that going to bump you over to the next tax bracket? Okay. Now, remember how we wanted to pay for taxes? On sale.
On sale, yeah.
That's right. So you really need to know what price you are paying for your taxes today, right? Yeah. All right. And then, so, hey, am I paying for these taxes at 12% or 22%? Or, my goodness, am I paying in 37%? Which, if you're doing that, I probably wouldn't do it. So you want to pay, let's say, 12% today and avoid the 22% or 35 or 37% later. Okay, does that make sense?
Of course.
Yeah. So like I have clients. This one guy, he was saying, hey, we were doing some planning a couple of weeks ago, and he's like, hey, I'm thinking about selling this piece of real estate, and it might be a $400,000 gain. I'm like, okay, great. You make sure you let me know when you do that. And by the way, this person's 71 years old, and he's got a ton of money in pre-tax accounts. And he's like, when is the best time for me to do it? And I said, buddy, you need to do it this year.
Yeah. Because
you are turning 72 next year, and you're going to have to take those required minimum distributions and pay a bunch of money in taxes. Mm-hmm. That's right. So you want to try to, in his particular instance, he fortunately for him, these are long-term capital gains, but he would really need to take, to sell this thing this year to help reduce his future tax bill, which is going to be next year when he has to take required minimum distributions.
Okay. So it sounds like 72 is not necessarily the end of rollovers. Or Roth conversions. It's just, that's when you really have to consider the RMDs. What about the minimum age? Because what if there's a 45-year-old that's saying, hey, I'd like to convert some now because I'd like that longer tax-free growth, yada, yada, yada. Is that possible, or is there like a sweet spot age-wise?
No, it's a great question. And that's a super question. And so if you are in a lower tax bracket, all right, that's when you want to do about it. But if you're talking about age, if you convert, let's say you had, $1 million in an IRA and you wanted to convert 100,000, you take 100,000 and you put it over to your Roth IRA, you pay taxes on 100,000. Now, you want to pay taxes from your after-tax money, meaning you better have enough. I would recommend that you would generally have enough money outside of your IRAs to where you can pay those taxes for the conversion.
Oh, okay.
Now, why is that?
I don't know.
Why is that?
That was my next question.
Yeah. You want to have the most amount of money in your Roth IRA. Okay.
Oh, so it doesn't get taken out of there.
That's right. Now, you can have, sometimes people, what they do is they convert, but they withhold taxes. But you're basically, instead of taking $100,000 out and putting $100,000 in, you're taking $100,000 out and putting $80,000 in, which negates a lot of the advantages. Now, if you're, like you said, you're under 45 years old, Eric, buddy, if you do a withholding then, you can get penalized because you are not 59 and a half yet.
So there is a magic number.
There is. Well, keep in mind that would be a penalty because you're taking some money out before 59 and a half, but you're also not getting the maximum bang for your buck. You want to put as much money into a Roth IRA as possible, and so hopefully you got enough money set aside outside of that to pay the taxes.
Okay, so let's use your number, 100,000. First of all, what's the penalty?
10% of the withdrawal. So like let's just say in this particular example, you take $100,000 out and you put $100,000 you put $80,000 in the Roth IRA because you're withholding 20% out. Well, you're going to pay a 10% penalty on that $20,000.
Jeremy, this is why I have these questions, right? I mean, it's complicated. It's not an easy thing to think about. We've got, different age ranges. We've got possible penalties if it's too early. We've got RMDs when it's later. That's a lot, man. I mean, I know that you have this knowledge, and you also work with CPAs, and you work with all sorts of folks that help you to decide what's best for your client.
Yeah, I mean, that's exactly what we do. The main thing that I'd like for the listeners to understand is that, hey, try to pay taxes on sale. And that's the main thing. And really, if today they can pay taxes at 10, 12%, and their future lifetime taxes, it's going to be, call it 22%, then it may make some sense. So now let me share with you where it would not make sense.
Okay.
It is like, let's say you're charitably inclined, okay, and you're giving money to charity on an annual basis today, or guess what? You may want to give, you did a great job of saving, and you're going to give money later on in life, okay? You can take advantage of what's called qualified charitable distributions, okay?
All right.
So if you're over 70 and a half years old, at least under current rules, you can take up to $100,000 out of your IRA and donate it directly to charity, and that would qualify you, or that whatever dollar amount you gave would be qualify you as your required minimum distribution, tax-free.
Okay. And that happens at 72, right? Your RMDs start at 72?
Yeah. Now you can do QCDs, as they call them, at 70 and a half, but you're not required to take required minimum distributions until age 72. Now, here's another little caveat. When people say, well, hey, is it better to get the tax deduction today? I mean, if let's say I wrote money out of my checking account to a charity, isn't it the same? No, it's not. It is not the same.
That's post-tax
a lot of
dollars.
Times, what's that?
That's post-tax dollars if you're going right out of your checking account.
That's true. That's true. But Eric, some people falsely believe that it's a one-for-one thing where, hey, I'm going to get this amount of money back on my taxes. And that may not be true. A lot of retirees, I mean, over 85, 90% of them don't itemize their taxes, or it doesn't make sense to itemize their taxes.
Yep.
So they may not be getting the same value after tax donating after-tax money to charity. It would be better if those who are over 70 and a half years old, in many instances, to do a qualified charitable distribution. Now, how do you do that? Okay. So what you can do, and many other custodians out there, just thinking Fidelity, for example, is they can give you a checkbook where you can write a check directly out of your IRA. Now, listeners, do not use that checkbook for anything other than donations. Okay. And then that would be, without getting too much into the weeds, that's a better way, tax-wise, in most instances, to give money to charity.
Sounds like a good way to me. I mean, sounds like that's a huge advantage.
Yeah, it is. Actually, when you do the math, there's a bigger bang for your buck. Okay. Again, you want to think in terms of taxes on sale, right? This simultaneously reduces it not only qualifies for the required minimum distribution when you turn 72, but it also reduces the IRA value somewhat, so that the future withdrawal on required minimum distributions are going to be less.
All right, that makes sense. So going back to the conversion, give us the highlights, because we're getting close to the end of the podcast here. I know I derailed you a bit with some different tax questions, but the benefits seem like they're pretty big if you're between the certain years that you're talking about. And really, I'm trying to figure out when somebody should really be thinking about doing this so it's most effective for them.
Perfect. If they find themselves in a low income year for whatever reason, I've got a friend of mine who, hasn't worked since February. And so it was just his wife working. There may be a great time for him to do a Roth conversion. For retirees, a lot of retirees, they may be in the 10 to 12% brackets. And before their required minimum distributions hit, that's a wonderful time to consider. Now, you really got to be careful of, Social Security, taxation on Social Security, capital gains, Medicare premiums and things like that. But that's all things that we do. And then when you do these conversions, you're building up a tax-free bucket of money, but it's also simultaneously reducing your future requirement minimum distributions. In other words, you're having Uncle Sam not knock on your door at 72 like you normally would.
Mm-hmm. Okay, so I'm assuming, and please, again, you always do correct me when I'm wrong, which I appreciate, but I'm assuming that near the end of the year is really when you want to do this, because that's when you're looking at, like you've spoken about retirees. It's not, retiring doesn't mean you're just done working. It means maybe you're done working at that specific job. A lot of people go into consulting. A lot of people pick up hobbies that they turn into a small business or whatever. So near the end of the year, you're looking back on all the money that you've made, part-time work or whatever you've done, combined with looking, like you just said, looking at what Social Security may be for you, looking at what Medicaid, Medicare, all these different little components. And then I'm assuming you're taking all these numbers and knowing what is a good number for you to convert in that year so that you're not pushing yourself into another tax bracket. Is that?
That's 100%. That's exactly right. You want to stack every bit of taxable income you can on top of each other to get a clearer idea of what your taxes will be for that calendar year. And you need to convert before December 31st of that year.
Yeah.
And so it's best to kind of do this in October, November, December. Okay. So you can have a clearer idea on what that would be. Now, a cool thing you can do, and I know we kind of wrap up here in just a sec, is you can combine, let's just say, Roth conversions with a charitable donor advised fund, which is basically giving a lump sum of money to charity. And you can do a combination of these things to really make this thing sing. But again, you're giving money to charity in this example. Mm-hmm. So really working with somebody to where, hey, what does my whole year look like? And can you help me decide on what dollar amount may make sense for me to convert if you are in a kind of a low tax bracket year?
Okay. Well, listener, here's the deal. This podcast published late September, early October. That's when you're listening to this. This is the time of year. So you need to be reaching out to Jeremy and his team. Jeremy, give them your contact information, because folks need to at least have the conversation to know if this is something that's going to be advantageous for them, if that's something they can take advantage of in this year before time runs out. How do they get a hold of you?
Well, you can call the office at 843-970-1049 or email me at jeremy@riverbendwm.com, or just Google Riverbend Wealth Management, Myrtle Beach, South Carolina.
All right. Jeremy, thank you so much for your time today. Fantastic information. You answered a ton of my questions.
Thank you, brother.
You bet. Of course, our last thank you goes to you, listening audience. Thank you so much for tuning in and listening to the Retire Happy podcast with Jeremy Finger. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Jeremy comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually does help others find the show. Again, thank you so much for listening today. For everyone at Riverbend Wealth Management, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Retire Happy podcast with certified financial planner Jeremy Finger. If you have any questions, please visit us at www.riverbendwealthmanagement.com or call us at 843-970-1043. And remember, click the subscribe button below to be notified when new episodes become available.
Investment advice offered through Stratos Wealth Advisors, LLC, a registered investment advisor doing business as Riverbend Wealth Management. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.